some of our new model portfolios. So we're excited about that and excited to partner here with DFA. We are going to be recording the call, so if anybody has to hop off early, let me know and we can get that sent out to them. I know we have a couple advisors who are not able to be on the call, but wanted to at least be able to view the presentation. I'm going to kick off the meeting here at the beginning, kind of give a little background, a couple operational points, and then we'll be passing it over to Rachel to take over the presentation from there from the DFA perspective. So again, we appreciate everyone being on the call. A couple housekeeping notes, I guess. I'm going to leave the lines open just because I know we have a couple different people who are going to be talking, so I don't want to try to mute and unmute from there. So if you can mute the phones on your end, that would be appreciated. And then second note is questions. We'll have time for questions at the end, but we'll do it in form of the chat box. So if you want to, throughout the presentation, just throw your question in there, and then we'll try to get to it in that Q&A session, Q&A time at the end. If we don't get to it, we can make sure to follow up and get you everything you need from there. All right, so we'll begin here. Give you a brief little background in terms of what we looked at for portfolios. So this has been probably a couple years in the making. I know I've talked to a few different advisors as to our portfolio makeup, our portfolio offerings, and what's available. So really what Tina and I had looked at is we want to provide some other options out there for our advisors this year. And so we really dug into what are we looking for and what are our advisors looking for. So a couple of things we had to look at is, from our operational standpoint, to be as efficient, effective, and low cost for our advisors as possible. Some of the criteria, obviously these have to be available at TD or Schwab. We want to make sure there's interest from advisors. We want to make sure the cost isn't a hindrance for the advisors and doesn't create a conflict of interest. That's a big thing. We don't want our advisors choosing or having even the thought of, hey, I chose this portfolio, could get paid more from U.S. advisors versus this one. Not even the idea of that conflict. We want to avoid that at all costs. And updates. We want to make sure that we're going to be trading these portfolios. So we want to make sure we get timely, efficient, effective portfolio updates from any manager or fund manager that we would go to utilize. Performance, we obviously want to see good, solid performance, long-term performance, and then support materials. I think that was a big thing we looked at is what type of support are our advisors going to get, and are we going to get from a home office perspective from a new manager? So we looked at that. We looked at, obviously, strategy type, asset type, frequency of changes, if there's any underlying strategist fee as well, underlying portfolio or fund fees as well. So we're looking at all these things. Tina and I had done a full-scale due diligence look at probably 500 to 600 different model portfolios and nailed it down to a couple that we thought would make a lot of sense. We did receive a lot of feedback from advisors from DFA specifically that have either used DFA in the past, currently using them in a different format, and then just wanted to have some more interest there. So that's one of the areas we started to look at. And obviously, as we went through it, we were impressed with what they had to offer from a variety of different aspects. So to look at, what we currently have, we're not getting rid of any of the portfolios we've always offered. Those will stay there and will continue to stay there. So from an LSA manager perspective, we have the American Funds portfolio, the ETF portfolios along the efficient frontier curve. We have the mutual fund portfolios, socially responsible, and then the 2 stock portfolios as well. With DFA here, and they'll get into it much more specifically, but we're looking at, we're adding their core wealth model portfolios. So that's going to be 6 different model portfolios covering the spectrum from more on the fixed income side to more on the 100% equity side. So we'll have them go through that in more detail. A couple of the whys for DFA. There are a number of different reasons. Obviously, we were pointed to them from the beginning from just the advisor interest, and that's always a great sign for us. We want to listen to you guys and hear what you have to say and what you're looking for, and that was a big push for us and to look more in depth onto the DFA's perspective. Some of the big things that we realized once talking to them, support and advisor education was big. We feel we're going to get great support from them, great information from them from a variety of different aspects, great support to our advisors, great support for us internally here as to what's going on with portfolios. Robust yet simple. I think that's for us as we were going through it, that was kind of a term, Tina and I had talked about, is they are very robust when you look at their investment history, their research, how they approach the markets, maybe a little bit differently than a lot of managers, but yet when we looked at the portfolios themselves, they're straightforward. They know what they do well, and they continue to do it over time, and that's what we liked. It's got a great background and a very simple story to tell as well. Access to information, I think, was kind of goes hand in hand with the first point, but it's the materials that they have, their research, their perspectives on the market, a lot of those different tools that we can help utilize and partner with DFA, I think will be great for us going forward. Resources from client materials, market commentary, business support, having some dedicated people that we can reach out to and our advisors can interact with was a big key for us as well. Messaging in the brand, how to present to clients, the story to tell. That's what we heard from a lot of advisors is we want to have a great story to go out there and tell our clients as to why we're choosing this model, this portfolio, this manager. DFA has that, and they have a very unique story to tell. So I think that'll be great. And then just in general, we want to make sure we have more options out there for advisors from a recommendation basis, from a Reg BI basis, to make sure you're covering all the different boxes you need to check when you're looking at what makes the best sense and is in the best interest of your clients. So I'll be sending out a follow-up email on more of the operations side of a couple of the highlights, but rebalance schedule. With LSA, as you know, we generally see a rebalance twice a year. This year has been a little bit different, but whether it's an update or just a rebalance, and with our stock portfolios, it's 4 times a year. DFA, what we're targeting is once a year. And DFA is much more static with the models that they build, and they might get into that as well. But there really aren't going to be changes to the individual holdings and the percentages, but it's going to be something that we want to make sure we're rebalancing for the client portfolios throughout the year to bring them back in line with the balance of the portfolio. And then in terms of the operations side, really on how to go about this. So after this presentation, if you're sitting there thinking, these are portfolios I want to get my clients into, what's the process for doing that? So first of all, with DFA, they are particular with the advisors that they allow to use their funds. So they know they do things a little bit differently, and they want advisors to align with their thought process and make sure they understand what the advisors are looking for in the portfolios as well. So Tina and I have gone through that whole training process, education process, their foundations conference. We've kind of done all that due diligence, but there still is a step that if you're interested, you're going to have to let us know, and then we in turn relay that to DFA. They then have to allow each master at Schwab to be able to trade DFA funds. So there is an extra step there involved, and that process can take as little as less than a day if we needed to, but that's something you're going to have to let us know. And then for this new model portfolio with DFA as well as State Street, which we'll be talking about tomorrow, any new account or any new account is going to need a new IMA. So we've updated the IMA to include these model options for those clients. So we'll have that as well. For existing accounts, say it's an LSA ETF moderate growth portfolio, and you want to change them over to one of the DFA model portfolios, we are going to need a new IMA in that case. The reason being is it is changing the underlying portfolio manager for the client account. That's a big thing, whether we go back to Reg BI or our discussions with the SEC, is we have to make sure the clients are aware of the portfolios they're in. If a client is just changing inside of LSA from a moderate growth to conservative growth, the portfolio update sheet is all that's needed. In this case, we will need a new IMA. So I'll have an email kind of laying all this out as well, and then feel free to give me a call when you're getting into those discussions and finer points as well. The final point is you'll hear on this call Rachel and Andrew, and I believe we'll have I think it's Mitch as well on the call. Rachel is going to be kind of the dedicated person we've all reached out to and dealt with, and she will continue to do that. So I'm going to turn over the call to her at this point. We appreciate again, we're excited about the partnership, appreciate all the information we've been able to gather from them, and are very much looking forward to continue that and see where this grows to from here. So Rachel, I'm going to find you at this point. There you are, and we'll make you presenter. And Rachel, I will let you take it away from there.
Wonderful. Thank you so much. Hopefully you all can hear and see me okay. I'm going to go ahead and share my screen with you all. And again, just holler if anything is looking funky to you. But Andy, thank you so much for that introduction. Really appreciate it. As you mentioned, my name is Rachel Levine. I'm a regional director at Dimensional Fund Advisors, and I'm very lucky to be joined by two of my colleagues today, Mitch Chamberlain and Andrew Lamb. And really the purpose of our discussion is to highlight that unique story that Andy was starting to lay out for us. What makes dimensional and what makes us unique relative to others in our industry. So our goal today is for the 19 or so of you that are on the call to walk away with a better understanding of our story, what it is that we do, how we do it, and of course, how that all culminates into the fashion of these new models that you're going to have access to, which of course, we are really excited about on our end. So to kick things off, I did want to get a pulse on the group. So I'm going to ask a little bit of participation from you, if you can. I'm sure there's varying levels of familiarity and knowledge of Dimensional within this group. So I'd just be curious to see how many of you think that Dimensional is an active manager, view us as more of an active style manager, or more of a passive style manager. And you could submit your guesses or your thoughts on that in the chat box if you don't mind. And I'll see those as they come in. And no penalties for any of those questions. So feel free to type in whatever you feel. I just see one coming in, one vote for active. Okay. Haven't seen any others. So I don't know if you guys are just being shy or unsure. Question marks, I guess, are an accepted response as well. All right. We got active, not active, and active so far. I expected a little bit of conflicting answers, so that's great. And then I get trick question. Yeah, it is a little bit of a trick question, in fact, and we're going to come back to this, but just keep that in the back of your mind as we go through our presentation today. Just to provide you all a little bit of background on who Dimensional is. We were founded in 1981, so we're approaching about 40 years that we've been in business. And over that time, we've grown to be one of the largest asset managers in the world, with now just about $500 billion in global AUM. And that growth has been in large part organic and through word of mouth. As many of you probably know, we don't do much in the way of traditional advertising or marketing. So this level of growth we've been able to experience, I think, is truly a testament to the clients, the advisors that we work with, and the experience that we've been able to provide over this time. Now, we are a global asset manager, as I mentioned, so we manage these billions of dollars across 13 different global offices in North America, Asia, and Europe. But truly what I think is unique and the takeaway from this slide is the fact that we have one investment philosophy. And that really is a differentiator when you look at us relative to others in the industry. We take a very consistent core view of markets that has been driving our firm from the beginning and continues to drive us today. So we want to spend a little bit of time, Mitch, Andrew, and I, speaking to that investment philosophy. We're also going to talk about the track record that we've been able to achieve as a result of that over our decades in business. We're going to talk as well about how we partner with advisors and specifically the support that we aim to provide you all who choose to work with us. And then finally, we're going to speak more directly to the new partnership with US advisors, as well as these new models that we're really excited to roll out to you all. So that's our planned guide for today. And to kick this off by speaking more directly to our philosophy, I'm going to hand it over to my colleague, Mitch Chamberlain.
All right. I think I turned my camera on, but I don't know if it's working. All right, let me make sure here. And I'll see my mug. Good to be here. Thanks, Rachel. So good to be with you all. When I think of dimensional philosophy, it kind of takes me back to when I started in this business. I started as an advisor like you all. I was back in 1995 in one of the wirehouse firms. And I did not have a philosophy. I certainly did not have one philosophy. I had nothing where I could kind of put a stake in the ground and say, this is what I believe. I didn't really know. There were so many different things coming at me. So it wasn't until kind of the dot-com burst in 2000, 2001, you all who were in the business remember that well, that I started reading some books and trying to get outside of what I learned coming up through the wirehouse world. And I, at that time, I actually discovered Dimensional. And their philosophy was so clear to me. It just kind of crystallized everything for me. And it wasn't until years later, kind of interestingly, that I came back and now work at Dimensional. But this is one philosophy we've had since our founding, so essentially 40 years. And we haven't changed that philosophy, but it's not because we're stubborn. It's because it's grounded in academic science. And so 1 year of returns doesn't really shake us, doesn't change what we truly believe to our core. And as Rachel mentioned, it is really unique. And so we'll get into understand how it is unique in the industry. All right, so what is that philosophy? Let's take a look at the foundational principles. Well, essentially, if you bring up the first one, Rachel, it's that we believe that markets work. Okay, you can call it the efficient market hypothesis, but we just believe in markets. Well-functioning liquid public markets work. And what that means is we think the prices are fair. Okay, so all these people are putting their information into the price, and we believe that's a fair value for that price. And to think about it in a different context than the stock market, let's think about if you were to go to a garage sale and you came across a painting that had a price tag of $25 on it. It was a really nice painting, kind of got you excited, and you don't know much about painting, but you just felt like, wow, boy, this is definitely worth $25. Well, let's say it was a pretty valuable painting. You didn't know that, but you liked it. How many other people would need to be at the garage sale to understand that there's value in that painting besides just you? And I would argue that there's only one other person, right? If let's say an art historian or an art critic happened to be over your shoulder and saw that this was actually a Picasso, there's no way you're getting out of there with that painting for $25, right? And so, in fact, the person selling it probably will overhear, and next thing you know, it's going to be at Christie's auction house, and you're going to have all that information. Everybody who understands that painting, understands the value of it today, the future value it may bring, they're going to put their spin on what that price is, and it's going to come to what we would consider a fair price for that painting. So now take that back to the stock market and the bond market, but if we're just looking at the stock market, and think of the millions of shares that trade every single day. And it's very smart people from the best schools trying to make money. It's your average person next door in their basement day trading. Everybody's got information, and they're all taking that and they're putting it into the price. And so that's what we mean by fair price. So all that's aggregated in there. And this is a different view on the markets than a lot of our competitors. All right, so next, what do we do with that fair price? Well, if you think about that we believe in prices, it allows us to look back for decades. We can go back to the 20s and look back at data and understand, okay, if we're taking those prices for being fair along the way, what can we understand about those returns? And the bottom line is securities have different expected returns and different realized returns. So it's very easy when we think about with a bond and a stock. If you think T-bills versus a basket of stocks, I think everyone agrees the stocks have a higher expected return. Okay. If you believe that, then when we get to two different securities and we look at stock A and stock B, you should therefore believe that there's a different expected returns between those two securities. And in fact, there is. We all know that. Not all securities have the same expected return. But how we view it is different than how maybe an active manager would view it. All right, so what we call these things, these characteristics that we've identified when we go back through years of data relying on prices being fair, what we've identified is these things that we call dimensions that we build our portfolios around. Many in the industry kind of used to look sideways at us when we talked about these, and now it's come around, which we feel is great. The industry's come around to see, and you'll hear it called factors or you'll hear smart beta, but we call it dimensions, just happens to be our name, dimensional too. So, all right, so you got the prices we believe in markets, we've got these dimensions they've identified. Now, how do we actually go out and capture that? And that's a foundational principle that I think sets us apart is our implementation we could spend hours with you all, and we love to, going through the details of how we design, manage, and trade and implement our portfolios. It's really fascinating. And I like what Andy said, robust yet simple. I mean, our process and all that we do is robust. We try to keep it simple. But we take these great big ideas in finance and we deliver them in real portfolios. And that's really hard to do, but we've become experts at that. Okay, so let's move on to the different ways that other folks out there, other major ways of viewing markets besides the dimensional viewpoint. And if you go back to the very first, when markets started, when the very first stocks you were allowed to buy them, it was really an active, you will call it, right? That's really all you could do. You pick this stock or that stock. But if we take that active management, those stock pickers into today, they're still around, obviously, and they have a fundamental different belief than us. But what they're trying to do is they're trying to rely on some sort of prediction, or they have boots on the ground. They think that they can understand based on the number of iPads or iPhones or whatever Apple's going to sell, or this macroeconomic event in the world. They're putting their perspective on it and trying to find those stocks when they're mispriced. So we believe they're priced correctly, but they say they're mispriced, and then they have to buy them when they're mispriced, and then the whole market has to then figure out they're mispriced. They come up in price, and then this active stock picker has to sell them once they've fully found their value. So it's a tough thing to do, and you'll see in some of the data we'll share with you that it's just been really a tough way to try to outperform. So then a good innovation from there was the index space, and actually the very first index fund came along in the 70s. And David Booth is our co-founder, and he was at Wells Fargo at the time and was part of creating the very first index, which is kind of cool. But so we think indexes are really great because they offer end investors transparency, diversification, low cost. They're capturing market returns. They're not having to outguess. But there are some issues with indexing that we see, right? They're very mechanical, and they're basically outsourcing what stocks they pick to a third party, like a Russell or an S&P or whatnot. And they're simply just buying and selling those when they're supposed to. And there's lots of traffic around those trades, if you can imagine. It's like buying roses on Valentine's Day when everybody wants them. Their prices are affected, and that affects indexing when they go to trade. So we think we can get around that, and we have. So we take some aspects of each of these, if you will, and you see the way Dimensional looks at it is the aspects that we take from indexing is we're diversified, we're low cost, we're very transparent, we're going to get capital market returns, right? We're not trying to outguess there. But the things that we do that active does is we come every day to the market to outperform the market. So if you think of an indexer, if they do a really great job, they're going to get that index return minus their fee and maybe a little bit less. That's a great return for many folks, but we want to outperform the market, and we think we can do it. And not only think, but we've been able to do it. We think we can continue to do it in a systematic way that you don't have to outguess the market. All right, so I want to share with you quickly the kind of the background for what we do is all based in academics. Just really robust research, and you're looking at some names here that you may or may not know. I mean, these are some giants in finance, and what's really cool about Dimensional, and I love this about being there, we're not in the office now, we work from home, which is too bad, but I walk around, I bump into these folks, and it's really cool. Eugene Fama there on the left is kind of known as the father of modern finance. He's been doing this, looking at data, literally, he works every single day for 55 odd years. And the gold banners there are folks who won the Nobel Prize. And what's a really interesting stat or point to make here, I think, is all those people there won their Nobel Prize after they were Dimensional. So really great academics know what we stand for, and they migrate to us. And it's just been really cool to see. And it's a lot easier to go find a Nobel laureate afterwards and pay them a lot to kind of carry your flag. But these folks have all been with us for a long time, Fama and French, since the get-go. That quote down there is really interesting from Fama, and I think it's important for y'all to remember as you think about Dimensional how it might be different. It's really tough, I think, to be an advisor today. When I was an advisor from 95 to 2002 or 3, we didn't have, our clients didn't have as much access to everything. There wasn't social media. There wasn't all these people coming after me like they are today to you with new ideas. You got this hot way to invest, and clients come to you with ideas. But what we see is we see a lot of these ideas, and what we realize is they're really not new ideas. Many of them are just a marketing spin. And so what you can feel confident with at Dimensional is that our ear is to the ground. We have this feedback loop with academia, and we know what things are really changing, really real things, not marketing spins. And it doesn't happen every day. It happens, every several years, 5 to 10 years, but the media and others would make you think that it's happening every day. Okay, Rachel's moving the slides. That's why I'm pausing here. Okay, there you go. So what I want to say is, how are the academics, what's the basic stuff that's come out of all that research? Well, I say basic, it's really not basic, but we try to make it look basic for you here. The three big things when it comes to equity, the three dimensions or factors that we pursue there are small stocks, value stocks, and highly profitable stocks. So you're looking at annualized returns, the blue to the yellow in small, for instance, 11.9 versus 9.9 annualized going back to 1928. Relative price or value, so value stocks in the long run outperform growth, profitability, high profitability, outperforms low profitability. Now, a point to make here too is this is not every day this happens. This is not every week, every year, every month, or every 5 years. In fact, right now, I'm sure you all are very well aware that value and growth have one of their biggest gaps ever. In fact, the last 3 years, value stocks, the value part of the market, has underperformed relative to growth. It hasn't done poor in absolute return, but relative to growth, it's the widest it's ever been. It's the farthest left tail of the distribution. But has that caused us to wonder, oh my gosh, do these things still exist? Not at all, because again, it's based in academic science, rigorous science. We know why these premiums exist. We know why we should expect them going forward. And we're not timers at Dimensional. We've done a lot of studies to see if you can time these premiums. Unfortunately, you cannot in our mind. But it's kind of cool the timing that you all are coming to Dimensional because, we hold broad portfolios and you hold everything. We tilt towards these things that we know have higher expected returns. So after a period of the farthest left tail, I would imagine going forward, we should see some nice returns of these premiums. Certainly I'm not guaranteeing, but it's my belief. And I invest alongside you all who would invest this way with my own personal money too. So, all right. So I'm going to show you this in a timeline because implementation is where we add value and we're overweighting these things. And this is just kind of going back 81, 93, 2013. Those are the big things. So going back to, you're hearing all this stuff from the media, big things happen once every decade. But there's a lot of other small things, if you could bring those up, that we are doing and we're innovating along the lines. And we do this because we're managing these portfolios every day for 40 years. And we are so in tune with academics and what's going on there. We have our huge, robust academic group within our research group within our walls. So there's various exclusions, things we add, things we take away. We're always tweaking the portfolios if it's sound and if it's something we can capture in our portfolios. I won't spend any time really on these. I guess I could mention momentum. That's an interesting one in 05, so 15 years now. We've been using momentum, but not treating it like it's its own factor or dimension like size, value, and profitability. And the reason there being, you have to be able to capture these things after trading them and managing them. And when you look at momentum, there's an awful lot of cost and trading that goes into that. And in fact, since momentum was identified in academia, it's been really hard to capture for those firms that try to just capture momentums. But we do take that information in how we trade. So we have internal algorithms. It tells us there's something in upward, neutral, or downward momentum. And that will cause us, as it will be a reason we don't sell or we don't buy if something has momentum one way or the other. So we definitely use it, but just not a premium that we build our portfolios around. And then lastly, as far as what we're doing every day, it's just so many things. And again, going back to Andy's robust yet simple, I mean, we could spend hours on all of these things. So I don't want to do that. We don't have the time to do that, but we're happy to get into detail with any of you on another call as deep as you want to go. But we're just doing things every single day to manage these portfolios. We try to capture basis points here and there and control trading costs. And we have all sorts of trading data that will show you how we pay a lower price than the trade before and after us, and we sell for a higher price than the trade before and after us. And that all comes back to our philosophy and believing in prices and believing that things are interchangeable. Stocks, we're not going after Microsoft versus IBM. We're looking at characteristics, and we'll just wait to trade a stock until we can get a favorable price. So a lot of stuff there. Went through that pretty quickly. But at the end of the day, I guess you would ask yourself here, okay, all this, but does it work? All this stuff should really come out in the wash, right? It should come out in our returns. And Andrew will share that with you.
Awesome. Thanks, Mitch. Andrew Lamb. I'm the senior associate who will be supporting USA Advisors. So thank you all for your time today on the go-to meeting, and look forward to supporting you all going forward. I think that I got the easiest section of the presentation because our performance numbers really speak for themselves. But we didn't want to just skip over this section because we know that it is important, and what good is an investment philosophy that's not backed up by the long-term results? But before looking at the numbers specific to Dimensional, we wanted to highlight the performance numbers for the active mutual fund industry as a whole. So among these funds that are trying to outperform their benchmark, any guesses as to what percentage of these funds survive the 10-year time period ending December 31st, 2019? So I'll pause for a moment and see if we can get a few guesses in the chat box. Again, how many of these equity active mutual funds survive the 10-year time period ending December 31st, 2019? 2,500 out of, so that's a majority surviving from Walter. Any other takers? Walter, you're going to be the closest if no one else guesses. Matt's guessing 1,000, so about 33% survivorship. We can go ahead and skip to the number, Rachel. The correct answer is actually 63% survived, meaning 40% of these equity active funds didn't even survive the 10-year time period. And if you look at the outperformance numbers, only around 20% survived and outperformed their benchmarks over the 10-year time period. And if we extend that time horizon to 15 and then 20 years, the numbers aren't any better. In fact, at 20 years, less than half of these funds even survive, and still only around 20% surviving and outperforming. So to us, this just shows the difficulty of trying to outsmart everyone else in the marketplace, or the difficulty of trying to pick a manager who's attempting to outperform. So at Dimensional, as Mitch was speaking to earlier, we feel like we have a more reliable way of pursuing outperformance. And again, it goes back to tilting towards these areas of the market that had higher returns over the long term. So just to cut to the punchline, if you go to the far right, it shows the odds of outperformance over 1, 3, and 5-year time horizons in an approach where you're tilting towards all three: small caps, value, and profitability. And you can see that that's the highest % chance of outperformance relative to just targeting one factor, and that likelihood increases as you extend the time horizon. I think arguably the most important slide, or at least the most important slide in my section though, is looking at the live fund results. So once again, comparing the industry versus Dimensional, but here we're adding in fixed income funds as well. The numbers don't change that much though. You still see less than half of these funds even survive the 20-year time period, and only 17% outperform for the industry. Contrast that with Dimensional, and it really is a huge difference where 100% of our funds that were around 20 years ago survived the time period, and 81% outperform. I do want to mention though, I mean, I think these numbers, like I said, really speak for themselves, and that's a huge difference relative to the industry. But if you all look at recent performance, you're not going to see the same results, because small and value have lagged in recent years, and like Mitch mentioned, in particular value over the last 3 years. But we know if you look throughout history, there's certainly 3-year, even 10-year time periods where even stocks underperform relative to T-bills. So we have so much conviction in this approach, the theoretical support behind the premiums, their long-term outperformance, and Dimensional's long-term outperformance really give us conviction in this approach, obviously over the last 20 years and over the next 20 years as well. With that, though, I think, tossing it back to Mitch at this point. You there, Mitch?
Yeah, I was unmuting.
Okay, great.
You hear me now, right? Okay. Okay, good. Yeah, thanks. So advisor advocacy is kind of one of our favorite topics at Dimensional. I would challenge anyone to find an asset management firm out there that believes more in the value of the financial advisor than Dimensional does. We talk about around dimensional a lot. We talk about delivering an outstanding investment experience to the end client, right, which is your client. And we know that you all are such an integral part of that. So we value the advisor, the role of the advisor, all the things that you do for the client that we can't do. And we know that together it makes a good team. We've been working with the independent advisors for about 30 years, 31 years now. And as Andy mentioned at the top there, we don't work with everyone. Historically, we have not. And it's a different model, but it's worked really well for the firms we work with and for us in the way we manage money. But we really like to be alongside advisors that are looking out for the client, doing the right thing, strategic long-term investors, and outside of the investments are doing all the planning that you all do. And so it's worked really, really well. We've actually set up our business, I think, different than our competitors, quite a bit different to support the advisors too. And Rachel will get into some of the details around that, but just to give you an idea of how we are personnel-wise. So Rachel works with, let's call it 30 clients, several $1 billion in dimensional assets, but only 30 clients. And if you were to look at another asset manager, they would have probably 100 clients that each regional director type of role works with. So we've just set ourselves up to be absolutely different, to support the advisor in a way that we think is differentiating, and we're working hard every day to continue that, to always be at the forefront of that. So I'll show you one quick slide that kind of visualizes that and the way we think about it. Very basic, but you guys have the client expertise. You all understand your clients, and we are the capital market experts. And when we can deliver some of the things that Rachel might touch on and support you all in a way to communicate what we do and have this really great philosophy that your clients will understand and believe in, and they have to quit looking around and worry about timing or picking stocks, what it leads to is an outstanding investor experience. And we've seen that. And when you have clients that are having outstanding investor experience, what we've seen in our benchmark surveys, and as we're compared, the advisors that we work with compared to the broader industry, we see really great outcomes for your business. So that's kind of the last part, that we've just seen great success in advisors who embrace this philosophy and kind of can let go of all the other stresses and focus on helping that client in all those other ways.
That's right, Mitch. And I think, you're exactly right. I actually work with 31 clients. So you're very close. And that's very intentional, right? I view myself almost more than anything as kind of like a consultant to the small group of advisors that I work with. I know them very well. We do a lot of things to help support their business. And I thought it'd be helpful to give all of you more context for what that support could look like. So the way we tend to bucket these areas of support are investment, messaging, and business strategy. Obviously, on the investment standpoint, that is our area of expertise. So of course, we want to provide everything you need by way of advisor education, which I know Andy mentioned earlier. We have a host of different conferences, now virtual, that we'd love to have you attend, other webcasts, the e-credit opportunities, things of that nature we can get you plugged into. From a tools and analytics standpoint, we also have a lot to offer as well. So we do portfolio analyses for your prospective clients in some scenarios, as well as if you're just looking to get a deeper view and understanding of these model allocations. More than happy to dig into our analytical resources to get that done for you. Quick snapshot of that on the left-hand side. Now on the top part of the screen, that's a snapshot of our model center. And that's something that if you work with us, you would get access to, able to dig into these models that we're about to unveil to you, run some reporting, share that with your clients, that type of support as well. And then we also have performance reporting platforms like our Returns Web software, which you can use to run customized performance reports of varying types of funds, indices, models, et cetera. So there's certainly a lot that we can provide you with in the area of investments. And then we're always happy to connect you to the best and brightest at our firm, whether that's portfolio managers for specific strategies, traders, research members, et cetera. So investments, as you may have guessed, is certainly an area we want to provide a lot around. But it's one thing to have an investment approach. It can certainly be another thing to effectively message that to your clients. And personally, I think this is an area where Dimensional does an excellent job. We have devoted so many resources, full-time positions, areas of investment around client messaging and building out a resource library that you can tap into to answer virtually any client question that you're getting. And so that can come in the form of things like unbranded slides and brochures, those types of materials. On the top left-hand side of the screen, that's an example of our unbranded quarterly market review, something we release every quarter that you're able to leverage in client meetings, add your own logo to it, change the fonts around, whatever you wish. That's very popular among advisors. We have many more examples of things like that. We also have many collections of resources around particular common topics like the value of advice or global diversification, or more recently, elections, right? That's probably something your clients have been asking about. How should I think about the election? How should I invest? So we have great amounts of detail, slides, articles, whatnot that you can leverage to help answer those questions effectively. And in a similar vein, we also have a group of presenters at Dimensional that are always ready to join client events, at one point in person. Of course, we moved those client events virtually to a Zoom format, and that's gone fantastically this year. So that's a snapshot on the right of a recent event we did with one of our speakers, Apollo, around the upcoming election. So we want to be able to make sure that you not only understand the story yourself, of course, but also have a means to effectively communicate that to your clients and make it as easy as possible for you. Now, finally, on the business strategy side, we know that there's a lot that goes into running a financial advisory practice, from how you think about servicing your clients to gaining new clients, whether it be through referrals or some type of marketing activity, how you structure your teams, how you go about recruiting and training employees. There's so much that goes into it. We've actually created an entire practice management team to help support you in that area. And that team does so many things, chiefly among them the annual benchmarking survey. It's among the largest in the industry, a great way to get a pulse on how you stack up relative to your peers, where there's alignment, where there may be differences, really insightful information there. We also have an investor feedback survey. That's a great opportunity for you to hear directly from your clients in terms of, hey, well, in this client experience, and what maybe isn't adding the value that you thought it was. So great to hear that direct feedback from your clients. And then we also have a host of different resources on various subjects that are relevant to advisors, like referrals, again, hiring, recruiting, areas that are common. Really, the purpose of all of this is, we're lucky to work with some of the best and fastest growing advisory firms in the nation. And so we just want to package up some of that insight we've gained through interactions with these firms and use that to your benefit. So those are some 3 areas we provide support. I wanted to put that into the context of what a typical advisor experience looks like working with Dimensional. So this is a timeline highlighting some example interactions, and I'll actually say this is not an exhaustive list. There's probably many more smaller touch points that happen throughout the year, but this just gives you an idea of what that could look like for you. And we've categorized this, color-coded it according to that framework. So green for investments, blue for messaging, and orange for business strategy. And you may look at this and say, wow, that seems like a lot. and I think that's a totally normal response. And again, just goes back to the very intentional way that we structure this business. I work with 31 clients so that I can do all of these things and more throughout the year, so that you're getting, all the experience, all the support that you would expect and frankly deserve out of a relationship with Dimensional. And I think what that leads to, and I think Mitch alluded to this as well, is just a better experience for your business and for your clients. This is something that we don't just witness anecdotally. It's actually something that we have some data around. I mentioned that investor feedback survey. We've gotten tens of thousands of end investor responses from that survey. And one of the key questions we ask is, would you recommend your advisor? I think that's a very good way to get a pulse on, are your clients happy? Are you running a good business? And are you growing, right? And this is something that, of course, many other well-known nationwide surveys ask. And here's some snippets from those other surveys. And these are big names, of course, PwC, J.D. Power, DFA Institute. What you see there is about 40 to 50% of these investors would recommend their advisor. Not a bad result, but I wouldn't necessarily call that a good one either, right? Potentially less than 50-50 shot of getting that referral. And so we were curious to see if Dimensional had any different response. And lo and behold, it was a dramatically different result. 98% would recommend their advisor. And these are all advisors working with Dimensional. And again, I think it's a surprising result, but to be frank, I think there's a very easy way to understand that result, because these clients are getting a investment approach that's rooted in empirical research, one that's easy for them to understand, one that resonates, one that's transparent, one that's consistent as well, right? And then they're also working with advisors that are doing the work, keeping that long-term focus, providing the discipline that's necessary for that great investment experience. And of course, getting support from Dimensional where needed along the way. And so, this is something we're very proud of and something we want to provide to all of our advisors, because at the end of the day, a happy end investor is why we're all in this business, right? That's why we're doing what we do. So I did want to pause there. We're going to move on to the models next, but I wanted to see if there were any questions from the group related to any of the material we've covered thus far. You can feel free to submit that either via chat or via just unmuting yourself as well.
I do see a couple questions in there. This is Andy, and we can touch base on those at the end.
Perfect. That sounds great. Yeah, we'll pause again for questions at the end, but just wanted to make sure if there's anything pressing on your minds, we got to it now. So let's go ahead and move ahead then to speaking about the models.
I do have a question. I do have a question just about resources. So I'm Whitney, and I used you guys through Loring Ward when I was at Eagle Strategies with New York Life. So I'm excited to see you on this platform. And so I know that there was a 401k consultant that we could work with. Is that also something that we'll have access to?
Absolutely. Yeah. So we have, that's a great question. Thank you for asking, Whitney. Yeah. So we have an entire group at Dimensional. We've gotten, I think as we've grown, we've gotten really good at specializing roles. So whereas maybe everyone kind of dabbled in DC work maybe 10 years ago, now it's a lot more specialized. So there's an individual named John Resurrection that we're happy to connect you with, who is a specialist and expert in that field and is more than happy to assist.
Okay, great. Thank you.
Yeah, absolutely. Any other questions before I move on? All right. Yeah, we'll save that for the end. So moving on to the models, I'm going to touch on this briefly with the caveat that for those of you that are interested in working with us, we are more than happy to set up a one-on-one session to go in much more depth on these strategies themselves. With the time we have today, we didn't have enough to really go in very deep. Hopefully this can give you a little bit of an idea of what these models are. And I think it's actually really fortunate timing, especially people who have worked with us in the past. They probably know that Dimensional has been reticent historically to publish much in the way of asset allocation guidance. And over the years, advisors have just continually asked us to please publish models, because it would be so helpful to at least have a starting point for how to think about pulling these strategies together for their clients. And so this year, this spring, we actually did that for the very first time. So it's a really exciting time. So many firm resources went into putting these models together. So I'm excited to share it with all of you today. Here is just a brief breakdown of the models themselves. And I'll use my laser pointer to orient you to these a bit. As Andy mentioned, there's 6 in total. So you can see that across the top here. And that's just really going to be split up by equity and fixed income. So starting at 100% fixed income, moving in 20% increments, all the way up to 100% equities, just giving you the flexibility based on your client's needs and risk tolerance. Now on the left-hand side, you will see the different funds that make up these allocations. And so that could be anywhere from 3 to 10 funds, depending on the model that you choose, which is very consistent with what we see most advisors doing when they construct their own models. If we focus just on the equity piece here, just from the naming conventions, you can see how we're getting global equity exposure, so US, international, and emerging markets, as well as a separate real estate portfolio. We exclude REITs from all of our traditional equity strategies, so that's why we're going to include it at a market weight here at the bottom. If you pan over to the right, you'll notice that the percentage weights across these different strategies is consistent across the board. It's going to be scaled differently, of course, depending on the weight of equities overall. So the same equity exposure is going to be present regardless of which model you choose. Now, if you look at fixed income, you may notice it looks a little bit different, right? You can see how we have different funds included depending on equity and fixed income split. And that's actually by design, and there's research backing that. If you think about an 80-20 model, for example, so I'll hover over that. In an 80-20, where 80% is equities, equities are going to be the main driver by far of the volatility of that overall allocation, right? You know, stocks are significantly, typically more volatile than bonds. So because of that, you have a little bit of wiggle room or the ability to add in more exposure to longer duration bonds and lower credit quality bonds, which would also be higher expected return bonds that will add to the overall expected return of this 80-20 allocation with a virtually de minimis impact on the overall volatility of that allocation. So that's why you'll notice we tend to have more conservative type bond strategies and approaches or in allocations that are dominated by fixed income. And then you start to increase your exposure a bit in term and credit as you move to more equity dominant strategies. From a fee perspective, as many of you may know, Dimensional is quite competitive when it comes to fees. Most of our strategies land within the bottom decile relative to our Morningstar peers by way of fees. So very low. Here what you're getting is globally diversified allocations that have just as much, if not more, diversification as the index, but with the opportunity to outperform the index, right? And so you see that very similar to an index approach where it's very low, you know, in the 20s in terms of basis points, in terms of a weighted average expense ratio. Now, I wanted to touch a bit more on those equity strategies and the construction behind them. And again, we can go into a lot more detail after this call. You'll notice that all of them had the term core equity in them. So US, international, and emerging markets. They all take the same broad approach. I'll just use the US as an example here, and please forgive my poor drawing at times. So the way that we structure these core equity portfolios is we start with the entire market. So let's say that box is representative of the entire US stock market, roughly 3,000 securities. So we're looking at these 3,000 securities at their market cap weights as our starting point. The first thing we're going to do is we're going to kick out those REITs. As I mentioned earlier, we exclude REITs from all of our traditional equity portfolios. We hold those in a separate strategy. The next thing we're going to do is we're going to categorize these stocks according to characteristics that we know inform expected return. So we've talked a bit about this already, but we have large caps at the top, small caps at the bottom, value on the left, and growth on the right. Then from there, you'll have to forgive this illustration because I don't have the ability to go 3D. From there, we're also going to consider profitability. If you pretend that these are boxes kind of going into the screen, we have low profitable names in the screen and then high profitable names at the box out of the screen. Again, bear with me here, but this is all just to show how we think about these different stocks and how they compare to one another, very similar to like a Morningstar style box. From there, we're going to take those market cap weights and intentionally deviate away from them to the point where we're overweighting this corner of the market, small in value, and also overweighting more highly profitable names. That's how we think about these core strategies. You're still getting exposure to all of those 3,000 stocks. Make no mistake, you're still getting the large growth, low profitable names in there, but just at a lower weight than their natural market cap weighting, because we know through the empirical research, they have lower expected return. And this is probably a prettier illustration of what I was getting across there, right? Our core equity one portfolio. Now to bring that to life a little bit more, we could take a look at some broad line characteristics of the overall global equity portion of the models versus a global equity index, the MSCI All Country World Index. First thing you'll notice, dramatic more diversification by way of number of companies, right? 13,000 that you're holding in that approach relative to a little under 3,000. You can see that our market cap is a little bit lower. Again, that's indicative of the size tilt. Similarly, you see a lower price to book ratio, which again is our value tilt. And then you may notice that profitability is in line with the market. And you may say, let's see if you're tilting towards profitability, why is that the same? Shouldn't it be higher? Well, the reality is when you're pushing harder on value and small cap, you tend to give up on profitability. So we are actually actively tilting towards profitability in this process, but it's hard to visualize that by looking at a top line characteristic like this. Hopefully that makes sense. Now moving on to fixed income, another visualization for you to get a feel for how these strategies compare to one another. This is taking a look across the maturity and the credit quality spectrum. So short term, let's say 0 to 3 years over here, moving over to longer term, let's say 15 plus years on the right, lower quality, double Bs, higher quality AAAs. We see our handy dandy T-bills are over here in the bottom corner, indicating that they're shortest term, highest quality. As I mentioned previously, you're going to have some more conservative type approaches in a more fixed income dominant allocation. So you'll see these portfolios, for example, in like the 0-100 and 20-80 strategies, because they're more shorter term, higher quality in nature. As you expand and get more aggressive, increasing your equity exposure, you're going to add in a little bit longer duration, a little bit, again, continuing that longer duration and slightly lower credit quality, all the way up into the 80-20, which includes Global Core Plus. That's the only portfolio that can dip a bit into the high yield space. And then we can just bring that to life a little bit further by looking at overall characteristics of these different fixed income approaches. We could see here's all of our different models on the left-hand side. And as we move more aggressive, we see our maturity increasing as well as our effective duration increasing. So at this point, I'm actually going to kick it back to Andrew, who's going to highlight the return experience that you would have received in these different model portfolios. So Andrew, let me go ahead and make you the presenter. Give me one quick moment. If it'll let me. I may need Andy's help here if I'm having a little bit of trouble finding the area to kick it back to Andrew. Sorry about that.
I think you can hit the 3 dots by my name and then make presenter. At least that's
how
I did it.
I just did it.
Oh, I think you got it now. Thank you.
You should be good.
Thanks for bearing with my technical difficulties. I tried my best, but doesn't always work out.
Can you all see my screen?
Yes, we can.
All right. Great. Well, up front, Andy, you mentioned support and materials as being one of the benefits of working with Dimensional. So I just wanted to quickly highlight an example of some of the materials and performance reporting we have to support these models. So this is a report that you all can generate on our advisor website, just showing asset allocation, fees, equity characteristics, country and sector breakdown, and it has performance too for this model. For performance, we also have a really cool program called Returns Web, where it has performance for Dimensional's funds and common industry benchmarks. So, sorry, I'm not able to see the right-hand side. Let me move this box. There we go. So what we entered here is the 100-0 model and the 60-40 model, actually using index data just because it allows us to go farther back into the past relative to all equity and 60-40 benchmarks. And you can see the 100-0 model outperformed relative to its benchmark, the MSCI World Index. The 60-40 model outperformed relative to a 60-40 benchmark. You can also look at it in terms of growth of wealth as well, and a variety of other metrics too. So just wanted to give you all a sneak peek of some of the materials we have to support these models. And there's a lot more beyond this too, but wanted to make sure you were aware that we can support in terms of collateral.
Great, thank you, Andrew. And I'll just close this out here. I know we went a little longer than expected. We want to leave a little bit of time for questions as well, but hopefully through this walk, you've gotten a better understanding of how we view markets differently from others, how we structured our business to better support you all and better support the end client. And at this point, I would love to take any questions that you all have.
Great.
I see Walter's
question,
so I'll jump to that first, if that's okay with you, Andy, and then maybe if you have others, let me know. Walter, we can maybe follow up with you after, because that gets a little technical depending on which portfolio you look at. We have about 100 or so. So we can focus on the ones in the model, of course, but we'll send that way your way as follow-up.
Yeah, and in terms of that rebalancing question for Walter too, what we had considered is all the other model portfolios that we're trading and investing in and rebalancing as well. So we're looking at it from that perspective. We're open to adjusting that as we go along, but we wanted to identify a time and place that makes sense to make sure we get that rebalance in to bring it back to that point where we're not over rebalancing, running into issues with other models and portfolios as well. So that's kind of where we sat, but we're certainly open to making some adjustments as we go along.
Yeah, and to clarify, I think you kind of hit on this, Andy, but this is guidance we publish. We don't manage these strategies. So it's totally up to you in terms of your rebalance frequency. We review them from a governance standpoint on a quarterly basis, but that's just more to make sure that there's no updated research, for example, massive changes in the weight of US, for example, relative to the rest of the global equity market, things like that. But in terms of rebalancing frequency, that's completely in Andy and Tina's hands. Thank you, Whitney. Yes. Any other questions? Anything you're seeing, Andy?
I do see one from Whitney. She had a question. I think it's more on our end, but DCA out of one portfolio into DFA. We aren't able to do that just because we can't have two model portfolios, say an LSA model portfolio and a DFA portfolio in the same account through Schwab. It's not possible for us to do that. So that makes it difficult. If it's a new account coming into it, that's possible. If it's not already in it and have an account set up at Schwab. The other question I think Whitney had was, what if we did foundations training before with DFA before you got to US Advisors Wealth Management? And anybody who is interested in utilizing these funds, we don't have to technically go through all that training in order to have access and in order for us to trade it, because we're trading it on our end. I know Rachel is going to follow up with an email on all the support materials that they offer, and part of that is going to be all the training that they offer as well. And we would highly suggest going through that stuff, but it's not going to prevent you from getting into these model portfolios from the beginning.
That's exactly right. Yeah, and I think the virtual environment has actually played nicely into this, where it used to be more of a time and money commitment to fly down to Austin, where we're located, and sit in a day-and-a-half-long conference. Now it's all virtual, and it's held on about a monthly basis. So a lot more flexibility, but yeah, certainly not a requirement. I know we've officially taken over more time than we asked for from you. So I really appreciate all of your time. To Andy's point, we'll be sending out a lot of follow-up materials as well as the contact information for Andrew and myself. So please don't hesitate to reach out to us with any questions, or perhaps if you'd like a follow-up call to dig into these models in more depth. We're happy to do that.
Perfect. Well, thank you all for participating. Thank you, Rachel and Andrew and Mitch, for hopping on as well. We're very excited and look forward to see where this goes and grows from here.
Yeah, thank you all, guys. Have a great rest of your day. Thanks.
Thanks.
Thanks, everyone. Bye.